Hi, Dominique, and welcome again to our week ahead, which has kind of turned into a weekly recap, week ahead, what we think is kind of interesting for our clients, investors to be thinking about. So hope you're well and say happy Saturday.
Hello, Andrew. Happy Saturday. I hope you are enjoying Florida.
Yes, I am. Thank you very much. Thank you. Okay, so let's dive right in. So I guess biggest thing last week was probably payrolls. So didn't seem, I guess it was kind of right down the middle what the market was thinking. What was kind of your interpretation, and did you kind of agree with, I guess, the kind of market impact on Friday? And anything else particularly interesting from last week?
Okay. So yeah, I mean, the payroll basically means that the Fed is going to go ahead with its 50 basis points in May. Personally, I think it shows that the labor market is easing, but you know how it is with economists, you know, there is always a way of tweaking the data in the directions that you wish. If you look at the very broad numbers, you know, unemployment 20 basis points below the long-term estimate of the FOMC. If you look at the headline number above 400,000, so these are good numbers if you want to hike, which by the way, I think the Fed should hike, and they should hike 50 and more. But if you look at things like hours worked, they continue to slow. If you look at increase in wages, real wages actually fell. Even if you look at the 3 months average of payroll, it's slowing. So it was okay, it was strong, but you get a hint that the labor market is easing, which is in line with my view of the economy.
Sure.
The other important release last week was personal spending and income. And there again, my story about, you know, the economy is slowing because you have this substitution of services to goods, and which is happening very slowly. And then you have also real incomes that are falling because of inflation. It was there. And also the most important thing was household savings rates increased, which makes sense because previously we were below the pre-pandemic levels. And so it means that you can't expect a big boost to growth from lower household savings, which means consumption is going to depend on household income. And since there is no way Congress will allow the administration to give more money to household to offset, for instance, the higher price of oil, it means that household income is going to be entirely driven by what's going on in the labor market. And as I said, the labor market is easing. So we're getting this picture of a not so...
But why did the savings rate go up then?
Pardon?
Why did the savings rate go up then?
Because people, you know, if you look at the debt of household since the crisis, they haven't increased much. People, you know, still have that debacle in their memories. They don't want to let their savings go below a certain level.
Okay.
And so, you know, that's what happened. Savings rate was exceptional when Biden was plying US household with these large transfers, and now no more transfers. So everything is going back to normal, including the savings rate.
Okay, so if anything, that's kind of a neutral to slight drag on growth.
Totally.
Fun. Okay. Okay, cool. So, and then the week ahead, you know, what are the key, you know, key data, key speeches, you know?
The Fed, and the Fed. Well, what I mean is that it's actually a data light week, and the key piece of action is going to be the Fed minutes. And there, I think what we're going to find out is the details of QT, and also a hint that QT is going to start in May. We are also going
Is that earlier? Weren't people like targeting June 1st or no?
No, Chair Powell had, hinted, he didn't quite say we will start in May because he can't, he needs
Right.
to.
Okay, so that's kind of base case, yeah.
Yeah, but he hinted, I personally expect or think it would be good to start in May. So, and I think he was kind of hedging because just in case the market collapses or, the war in Ukraine becomes somewhat, a bigger conflict, or
Sure.
you know how central bankers are, they don't like to stick their head above the parapet. And so that's what he was doing. But I mean, for all practical purposes, I think it's May. And I think they are likely to start small and then increase. So they could start with 25 billion of, how it's going to happen. There will be a reinvestment ceiling. So I could see very well the ceiling around 25, 30 billion getting raised every other month, say, and then a sort of a cruising speed of about 100 billion ceiling for reinvestment.
So it's only reinvest. I think I was asking about all of this. So it's only reinvestment. It's not a point of that they will be selling bonds into the market. They just won't, as they come due, they won't buy new ones. Or
so,
as they, I guess, yeah.
So there are several schools of thought in the FOMC. There is a school of thought led by Esther George, who has been very consistently the most hawkish committee member. She thinks that it would be much better to actually shrink the balance sheet before hiking. I mean, obviously, she's in the minority, but still, the balance sheet is being shrunk much sooner than last time around. And she probably would like to see outright sales. But the consensus view in the committee is that it's just going to be about reinvestment.
Right. Okay.
So
and yeah. Sorry, just to recap, the last time that the Fed undertook quantitative tightening, and remember they said it's going to be autopilot. Obviously, it ended up not being on autopilot. What point did they get to? I'm just curious. Did they get to a point of selling, or was it always just slowing reinvesting? Yeah.
It was slowing reinvestment, and you're right, they had to stop because they had completely underestimated banks' demand for reserves. And so they slowed the reinvestment in the spring of 2019 and ended them completely in 2019, in the fall of 2019.
Fine. Okay, cool. Yeah, so is that, what are the main things to be looking for on the minutes? Or if it's, what's so interesting if it's 50 basis points going to happen in May and quantitative tightening? I guess, like you were saying, the numbers that they will talk about or they would have discussed in quantitative tightening, or is there other stuff to look out for?
So I think we will get a sense of the discussion between doves and hawks on the pace of easing. And to me, the really interesting part of the discussion is whether there is an understanding that their framework to figure out inflation, so the famous inflation expectation augmented Phillips curve, has been completely falsified by the data. If you look at survey-based inflation expectations, they are very stable. If you look at the Fed index of inflation expectation, which is a mixture of survey-based and market-based, so BEs, basically. It's up, but it's up to the level of 2014 when inflation was about 1.5%. And what is extraordinary is that within the Fed itself, you have a very senior economist who wrote a paper a few months ago saying that the concept of expectations are rubbish, that there is no logical or empirical consistency. And it's really important because the reason one of the reasons Powell waited for so long to change policy when inflation has been accelerating for more than a year is because the previous boss of the Fed, Ms. Yellen, she had written a very famous, she'd given a very famous speech in 2015 explaining that under the expectations augmented Phillips curve, as long as inflation expectations remain stable, you didn't need to worry about things such as supply shocks. That basically she saw inflation as a series of deviation along a trend that was driven by inflation expectations. And those deviations could be caused by things like commodities prices, the dollar, or any other shock. And so poor Chair Powell just, put a great deal of faith in his former boss' view of the world. And he thought that, the supply shock would take care of itself. And it's very clearly false. It's not the case.
Right.
And where this is interesting is because if you look at previous episodes of tightening, of Fed tightening, when they took their time and the tightening was protracted, like for instance, around the second oil shock, the tightening started really in 1977, but really didn't get where it needed to be until 1980. You had a very deep, long, and painful recession. So my concern is that the FOMC still has a lot of faith in its model and believes that the current imbalances will prove self-correcting, which is basically what the expectations augmented Phillips curve tell you. And so I was, listening to Williams, so the president of the New York Fed today, who gave a speech on a Saturday, very unusual for central bankers. Usually they keep to office hours. But anyway, it was an interesting speech. And he was saying, yes, we need to bring the rate closer to its neutral level. We don't have to rush to do that. And to me, it's very worrying because it indicates that they are still thinking in the old framework, of that famous Phillips curve, which I think has been falsified, and that if they postpone hiking strongly, we might end up in a late 1970s scenario with a deeper and longer recession than we need to have, really. So,
so with that, if there's 250 basis points hikes, followed by 25 hikes at every meeting for the rest of the year, and QT goes along the patterns that you kind of anticipate at this point, do you think that's enough?
Probably not, given where look at nominal GDP, it's about 15%, which is where it was in the mid-70s. But the Fed funds, has just gotten off the zero floor. So, but the problem is you can only do so much at a time. I mean, what I mean is that if they go 50 for 4 meetings, they will destroy the market, the economy, God knows what else. So they need to do 50, maybe a couple of times.
Why do you think that? Because everyone was afraid of the cycle and everything, and now it's clear that at least that probably these first 2 meetings are 50, and that at least for now the equity market is kind of coming to grips with it. But you think 450 in a row would probably freak out the market?
I think I mean, I think it would be really careless. I think they need to do a couple of 50s, see how it plays out, and then do more 50, because the Taylor rule Fed fund is about 9%. They are so far behind the curve. So they need to catch up as quick as I can, but they can't like suddenly turn around from taking a year to end QE.
Right. We all agree this was the wrong thing. Yeah. And there will be a transition. There'll be a transmission. It could take 6-9 months for those hikes to be fully felt. So it makes sense that they should have some period of allowing that impact to have on the market. So maybe 50 series of 25s, and then okay, I got you. So what about
so for our listeners, what is really important is to get a sense of whether the FOMC as a whole understands that their model that said not to worry, everything will take care of itself, that their model has been falsified. And I don't get a sense, listening to the like of Williams, who is one of the more influential members of the FOMC, or even, we have these new FOMC members coming. I mean, we have Jefferson, who is an economics professor, is going to vote with the middle, but we also have Lisa Cook, who is a Black Lives Matter activist, likely going to be the most dovish member of the FOMC. She'll get a vote, a permanent vote, because she'll be a governor. I'm not sure that she realizes this is what's going on. So let's watch out and see if the sort of a collective mindset of the FOMC has adapted to the issues we are having right now, rather than the issues we had for the past, basically since the GFC, which were very, very mild issues and shocks.
Yeah, so inflation. Okay, that's great. I saw we have services PMI, which is that the only other big data number, and is that something worth looking at, or?
Sure. I mean, the US is a services-driven economy. The employment component of that survey has been weak. And that's one of the reasons I thought we would have a negative surprise on the NFP. So that's definitely worth looking at.
Yeah. Okay. And then if there's, outside of anything else, I saw you, and I was just reading before, the pretty deep dive you did onto kind of the residential real estate market in the US. Do you want to kind of just briefly touch on that, and if any, and just like 2 or 3 key things that investors should be thinking about, or that you want to reinforce for people who have, gotten access and read it down?
Okay, sure. So 3 points. If I can, I'm going to share my screen. So 3 things on real estate prices. Number 1, inventories remain tight, and which I'm showing you here in terms of a month of sale. Inventories of existing home are like below 2 months, which is a historical low. Higher inventories for new homes, but these are only about 20-25% of the market. So market is tight for the short term. Second point is that
one question on that one. We did see such a quick spike from, I guess that's like 06 to obviously up to 07, 08. Could you see a quick spike like that, or do you think this will still be kind of gradual? Yeah.
You mean a collapse or a spike in prices? Yeah.
Yeah. I meant like a quick
turnaround
release in in such a tight market that for some reason buyers will be pulling away and
So that's very highly unlikely, because in actually, let me show you something called the affordability index. Hold on. Okay, so because what we had in 2008 is basically an abysmal failure of underwriting standards. So a lot of people who should never had gotten loans got them. And then what happened is that the Fed hiked rates, banks started to tighten mortgage standards. And then all those people had properties they couldn't pay for, and the distressed property were foreclosed and put on the market. So the reason we had this big decline in prices, let me show you a big turnaround in prices, is because there was an amazingly large scale misuse of capital, that supervisors, banks were not doing their job and giving loans to people who never should have gotten them. Obviously, this time around, underwriting standards are much tighter. And that spike you see here in prices, actually, it reflects a few things. First of all, that nominal incomes have gone up.
Yep.
Then you have the fact that the Fed has really cut rate dramatically. And also, I think the reason for the spike is in part because you have a new class of buyers who are institutional buyers. But before I get to that, I want to show you something else called the affordability index. And the affordability index is basically showing you the buying power of your money in terms of real estate. And so what this index is a ratio of median household income to qualifying income. And qualifying income means the minimum level of income you need to qualify for a mortgage, which is a function of house prices and interest rates. So the higher house prices and mortgage rate, the higher the qualifying income, and the lower the affordability index.
Sure.
And so what you can see here is that before 2006, you had a dip in the affordability index for the reasons we just mentioned, the run up in prices, a slight increase in mortgages. And this time around, you've had quite a dip, but you're still well above the affordability that prevailed in 2006. So essentially, the low mortgage rates and the steady income growth of household have offset the negative impact of higher prices on affordability. The other thing I want to show you is that since the GFC and until recently, the ratio of house prices to household income was actually quite stable.
Right.
So I really, really don't think we are in a GFC
About
type.
to be collapsed. Yeah.
However, let me show you the next graph, which is kind of interesting. So this graph is showing you recessions in gray, and it's showing you new home price in yellow. And you can see that in recessions, new home prices always the inflation, so the rate of growth of home prices slows. It even gets negative, I think, in three recessions. But look at the affordability index, which is the orange line here. It really doesn't go down much. Sometimes, during this recession of the early 2000s, it didn't go down at all. And basically, the reason is that affordability looks at median income. It doesn't look at unemployment. So, and when you have recession, unemployment goes up a lot, while median income is quite fixed. It's because you have nominal wage rigidity. So instead of people seeing their income go down, when you have a recession, what typically happens is that people are losing their job. And that's not something that is picked up by the affordability index.
Mhm.
And that's why I think it's a really poor predictor of what's going to happen to the market. So you know that I'm expecting a recession next year.
Yep.
And I think it's very likely that we will see prices go down in that recession. Now, price inflation go down. Whether we actually get outright deflation and a contraction in prices, I think it's going to depend on a new category of owners, and that's my third point. This is going to be the first recession with a large ownership share of investors. Not so instead of the housing market being completely dominated by people like me and you, homeowners. Since GFC, we've had a number of firms, REITs mainly, but a few listed companies as well, that have been buying single-family homes. And you can see it here. The blue line shows you the share of a household in real estate investment. And you can see there is a big break after the crisis, and the share goes down. The data is up to 2020, but if you look at anecdotal evidence, you have the invitation homes, you have Blackstone, you have
I mean, I know that because I have friends of Blackstone, even BlackRock. I mean, they're focused on raising tens and tens of billions of dollars, which they have specifically in the U.S. In funds that invest in in single-family homes, single-family rental homes. Yeah, so it's a good question. So, does that mean that the demand is more fragile or less?
I think the demand could be more sensitive to funding conditions. So if suddenly it becomes more expensive for those guys to raise money, because I was looking at rental yields, we are talking about 7.5%. It's good. But if suddenly the cost of funding goes up, or households are no longer able to afford high enough rents, this demand is likely to be more volatile than that of the homeowner, who, if prices go down, nothing happens to them. They just stay where they are. While since a lot of the flows, and it's been actually quite controversial, institutional buyers have been accused of bidding prices up. So since a lot of the flows into the market over the past few years have been driven by people like your friends, there is a chance this could disappear if we have, a really nasty recession with the usual combination of a higher cost of funding and tighter credit conditions. So I think that's a risk. That's a risk for next year. So in other words, want to buy, wait for the recession.
Yes, I was going to say, I'm very much in agreement with your analysis, and I can just say anecdotally from being in Florida, there's every person I know is speccing on homes, and people entering the real estate ecosystem somehow. And from talking to people, it does bring out that similarities to 06, 07, 08. The only caveat I would say is, and obviously I think that the world is probably more fragile than it was then. I'm not sure exactly to your thinking. It's probably not in the next month. It probably will be a process, and early next year feels like probably the right target to see real impacts.
Very much so. I mean, you look at how tight inventories are, that gives quite a caution to the market. So I
Right.
really agree with you on this one.
Okay, cool. Okay, awesome. Well, thank you again. And, we'll speak on Monday, and this was awesome.